without anybody stepping in, if I have a $100,000 exposure limit, I just go in and I take a previous ACH credit payment, I change the receiver's information, I upload the file through online banking, or maybe it's a template within online banking. I push a payment out, and because it's going to be at or under the dollar limit established, it's most likely going right for a ride through the network. And then when I get that call as a banker to say, what was this? You're going to say, well, we had the limit. You've agreed to security procedures with us.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Hello and welcome to Wrestling Payments. We're here today. We're talking about something that caught our eye. Sean, you were looking through your email the other day and you came across an article by Jordan Bennett of NEACH discussing payment modernization and digital transformation from the perspective of exposure limit. For anyone who's not familiar with an exposure limit, Sean, what's an exposure limit and what are we talking about?
Yeah, so exposure limits typically are dollar limits that are assigned to a cash management customer, whether it's ACH or wire. And in theory, an exposure limit is meant to protect both the customer and the institution from different types of risks, whether it's operational, fraud, credit. However, I think the purpose of this article is because a lot of people have just treated exposure limits from the view of credit exposure. And the reason this caught my eye is because I've been talking about this for years with our members, having done audits and risk assessments. We write a lot of people up because their process for establishing these limits is literally just a credit review. And you could argue over the last couple of years, your bigger threat has been on the operational risk side of an account takeover or business email compromise and someone pushing out a payment. An exposure limit should be able to guard against that if it's done appropriately. So it's a great topic. RMAG did a great article, as you mentioned, written by Jordan, but they get input from the group. It's a really good article. I suggest everybody go take a peek at it. But that's what you and I are going to discuss today, kind of take this and muddy it up a little bit and throw our own feelings around.
All right. So I'm going to disclose I consider myself an ACH guy. So I talk about ACH all the time, and I'm going to let you guys in on a little secret. Sean and I both work in the office, and we have conversations throughout the day. And we had a conversation this week where we had to set up a merchant account. Without mentioning names, as you compare setting an ACH exposure limit and setting us up to accept credit cards, any observations?
Yeah, it took us about 20 minutes to set up a merchant account to accept credit card payments. They asked some very basic questions, more on the CDD side. They didn't really ask much about what we expected our, average transaction or anything that in that regard. I was kind of dumbfounded by how easy it was to do that, because we had previously done it with a different company. We had to do a bank statement. There was some work that had to go into that, which we didn't have to do this time. And I'm not judging. I'm not saying one is better than the other. Absolutely, I don't want that to come across. I just found the strike. Remember, we were dreading back and forth in the email who was going to take the lead in setting up the account. And I'm like, oh, okay, I'll just do it. And it was really easy. But when you think about in ACH, right? So this is to accept credit cards, which have, we're taking business to business credit cards. I highly doubt we're going to have many chargebacks for people paying NEACH Payments Group for anything. So when you think about exposure limits, right, in an ACH context or even accepting card payments, right, it's really about what do you expect is going to go wrong and how do you protect yourself, right? And so when you think about how people have been doing things with exposure limits and almost to a fault, right, is they just worry about the complete failure of the business, right? And that's what they seem to be guarding against. And it's like, how many of your customers have completely folded, right? Whereas if you asked another question a different way, let's say you're a merchant provider as a bank, how many of your customers get chargebacks? Oh, 100% of them, right? How many of your customers of an ACH debit get returns? Oh, 100% of them, right? That's really what you want to be guarding against. And so it was really interesting how this article was written as well, right? Because under the NEACH rules, prerequisite to origination for ACH, you must establish, enforce, monitor, and review exposure limits. Nowhere in Article 2 does it talk about credit risk. It talks about all the risks that an originator represents to the institution. So if you think about today's day and age, when you're coming up with that number for an exposure limit, what if a company is an absolute train wreck with their IT security and their practices as a business, right? But let's say they're very sound financially, so their financials look good. If you give that party a limit, right, you're more likely to have an operational disaster with them sending money to the wrong customer or duplicating a file or you name it, more so than them going out of business. So I think the point of what Notch and Ahmed were trying to get across is something we've been trying to get across, is that the process of doing an exposure limit, the way people are doing it actually is causing heartache, right? Because the lenders hate being responsible for it, right? You have lenders that at most of our member FIs and our clients, the cash management has to get lending approval to give a limit to a customer. The process takes way too long, judging by how easy it was to get this other merchant account versus how even us getting reviewed as an ACH.
Let me ask you a couple of questions.
Yeah.
Based, and we'll not that it's fair, and we're not naming any names, but let's compare and contrast the signing up for a merchant account and setting of exposure limits. My observations. So first on the merchant account, we are signing up to accept credits. So we're going to receive credits. That's all we're going to do. One thing. When you talk about the ACH, you're potentially looking at both sides, even if it's just a funding debit to fund credit you're sending out. So, and I always thought people in general in our industry kind of threw this part away. They kind of, oh yeah, we got to set up exposure limits. Mm-hmm. And the article seemed to say, oh, no. Do you want to explain why?
So exactly the point of the article is that this process needs to be taken seriously, but in a way that it benefits you, right? So it's one of those things where you're highlighting the need to do something from a regulatory standpoint, but it's actually for better good, right? And so when you think about what we just went through, right? These folks are just gonna, send us a credit, if there's a chargeback, they then come back and debit the account. They don't know if we're gonna have money or not, whatever. But when you have the way people write limits sometimes in ACH, and we write people up for this actually, is the customer will say, I need a $100,000 credit limit, and then they automatically assign a $100,000 debit limit. And the person never asked for that, right? So let's say you did that in the reverse order. I wanted a $100,000 debit limit, and you also give me a $100,000 credit limit. And then I have an email compromise that pushes out a $100,000 ACH credit, and I come back to you and say, I never wanted to send that big of a payment.
Time out just for a second.
Yeah.
Go through that scenario. What could happen if they didn't have good IT, they did get a compromise, someone had the credentials? What could that entity do without anyone taking a look?
Yeah. So without anybody stepping in, if I have a $100,000 exposure limit, I just go in and I take a previous ACH credit payment, I change the receiver's information, I upload the file through online banking, or maybe it's a template within online banking, I push a payment out, and because it's going to be at or under the dollar limit established, it's most likely going right for a ride through the network. And then when I get that call as a banker to say, what was this? You're going to say, well, we had the limit, you've agreed to security procedures with us, and
I'll play the other side. We never asked you for a credit limit. We're just sending out debits. Why did you give us a credit limit?
And a lot of times the answer is the system makes me do that. And it's like, well, the system is a problem, right? Because you should really be underwriting based upon the NEACH rules say this, based upon the risk that the originator represents to the bank. So if they're not asking for a credit limit, why are you giving them you shouldn't have to manage anything related to ACH credits because they're not sending them, right? So this is a great area for financial institutions to take a step back. And is there a way to make this process more efficient, right? And the reason I say that is you could create a questionnaire that the customer fills out that includes the IT stuff. And then with your lenders, they only have to look at a portion of the process, right? Does this customer have the ability to pay us back? Now, the other part of this, from a lender standpoint, they're used to saying, can the person pay us back 10, 15, 20 years from now? With payments is, can the person pay us Thursday? And that's a really different mindset. And I know a lot of lenders talk to me, they reach out to us and say, hey, they're asking me to do this limit. Can you make us understand how the ACH or the wire system works before I prove this? So it is the way it's being done is very tough because number one, we're putting it on to people that might not truly understand the payment, and you can't manage risk unless you understand the payment system. You just can't. I'm sorry, you can't do that, right? So, but then they're also missing the entire operational fraud, compliance risk related to these payments, and some of it, to be honest, the system says, I just can only put a limit here. This is what's in our active ACH policy because you have to follow policy at the institution. Policy maybe have been written before all these IT troubles became prevalent in payments. So it's tough, but it is actually the rule that you're supposed to be doing it in the way you and I are describing. It's supposed to be a holistic review of the risk that the originator represents to the institution. Not your originator as a whole, not a subsection of your originator, each originator to the bank. Like our bank does with us when we do that annual review, which is not a problem we'll get into in this podcast. But if you're just looking at my limit every year as part of the review and saying Sean has a good exposure limit, you're missing the boat, right? Because have I used it up to the limit? Have I come close to that limit? Were there other issues throughout the year, like I needed to send reversals a bunch of times because I keep duplicating files? How many times have I been hacked? That review process should not just be, oh, good job, credit, we'll give them the same limit going forward. It really actually has to be a periodic review of the limit, which includes the holistic review of the relationship.
Just a couple of questions. So, easy one first. This should take about 2 seconds. Sometimes you would go in and see all the exposure limits, and weirdly, it was all $1 million.
Yeah.
What's the problem with that?
Yeah, I mean, giving everybody the same limit, I've always argued is a violation of the rule. Just like in here, it also highlights, Joe, those people that say, oh, we do pre-funding. We don't have to have an exposure limit. Not true. The rules don't actually say, well, if you do pre-funding, you don't need to do a limit. And there's a reason for that, and I'm going to explain this to you. A lot of people do pre-funding, and there's a couple different ways to do it wrong. Number one, they're not actually pulling the money from the account into an account the bank owns. So that's the first problem. So people have kind of corrected that over the years. That's less prevalent. But now what I see is people say, oh, yeah, we pull the money. It's in an account from the bank, but you're actually not pulling good funds because you're allowing people that just did an RDC deposit. The funds aren't final yet, and you're sweeping those funds out of the account to fund the ACH. What happens if you get a check return? So when you say pre-funding, and when you're talking to your regulator, they're assuming you mean you have zero risk on that money. because that's how they define pre-funding. If you actually have money on that risk, what you're doing is risk on that money is what you're doing is not pre-funding. It's sort of pre-funding. It's like a pre-half funding. I don't know what the word would be, but yeah. So that's another interesting one. Is like we go and we see everybody that does web has $1 million limit. It's like, well, they're not all selling the same product. They're not all the same companies. And again, sometimes people will say it's easier on our system to give everybody the same limit. I get it. But at that point, you need to investigate different ways to do it. I'm not going to promote any products, but there are different products other than the core system. The Federal Reserve has products, EPN, if you use them they have monitoring tools that you can do your limits in, and you can use multiple systems to monitor limits. So that excuse isn't a good one anymore. Like, we have to rely solely on our system, which isn't true anymore. There's other ways to do it, and people, once you read this article, you should explore all the ways that we can make this a more, again, if it's an efficient process, people are going to take it more seriously, and it's not a check-the-box activity, which it has become at a lot of organizations, because they don't want to go through the pain of asking you 10 or 12 IT questions, right? Asking you, these things. And I just think it's really important that we broaden how we look at exposure. And not just for ECH,
Let me jump into a different part of the article. Now, I have to admit, I only skimmed the article. I'm sorry. But, and this is certainly part of a bigger originator onboarding conversation, but the part I did see on this is, and again, I think if it's a throwaway, I think it may be that the originator may not even know. What if there's a third-party sender involved? And what is a third-party sender?
Yeah, this is a great part of the article again. And this is really why I like this article. Right? So if you like this stuff, it really is a good article. Shout out to Jordan and the folks on our mag at NEACH. When you think about a third-party sender, which by definition is an entity that exists between the ODFI and the actual originator of the item. So now we're adding a layer of complexity onto a relationship. So if you as a financial institution are underwriting your third-party sender as if it's one company, that's a problem, right? Because they're originating for multiple companies. The second part of that problem is, let's say you're doing a good job with your own limits in underwriting the third-party sender. Are you ensuring that the third-party sender is imposing limits on their customers? And if you think you're doing a good job, you should be expecting the same level of risk management and due diligence that you're doing to the third-party sender. You should be imposing that on your third-party senders and their originators. I see a lot of FIs don't do that. They'll say, oh yeah, we have a really great risk management program in place, and we ask them, do you make your third-party senders do the same? No. Well, then they're doing less than what you're doing. So your great program that you built has been weakened because you're allowing this third party to not act in the same manner. And you can do that through agreement. You control the relationship. And so, yeah, I do think it was kind of just in there like, hey, keep in mind, you could have third-party senders, but this is an area of weakness we see. Not that people have 20, 40, 50 third-party senders, but if you have 10 payroll companies and they're not doing anything, right? They're doing a handshake and asking the customer what their payroll is, and then you're telling everybody how safe you are, I think you're missing the point. And especially in payroll with the direct deposit fraud that's going through the roof, what are they doing to make sure they're protecting their computer systems and all? And it's got to factor into, maybe it doesn't factor directly into a limit, but at least in your risk rating, which then through policy should affect what limits or how you monitor them. Yeah, really, really good point by you is that third-party sender piece.
Mm-hmm. I caught that part.
Yeah, it's going to go down another level with nested third parties, right? Now we could get crazy here, but yeah, really interesting.
So we will put the link in the article and in the post, so you'll be able to read the article yourself. Anything else? What did we miss?
No, really, I think the intent of the article and hopefully the intent of the podcast is just to get the people think differently, right? So, the baseline of the rule is an exposure limit, and nowhere in there does it say limited to the credit risk, right? It's talking about the total risk an originator represents to an ODFI. And I think if people look at it in that lens, it makes more sense, and they'll do a better job. Also, mentioning the systems that people are on, sometimes you have to push back. If your system is preventing you from doing good risk management, you got to call the vendor and say, this doesn't work for us. I shouldn't have to put the same limit, for debit and credit on each customer. That's just ridiculous. That's like 1980s setting up ACHs. So I do think there needs to be pushback there.
So let me ask you one more question. This one's really, really, out there. We had a rule call yesterday. A financial institution was setting up origination. It may be for the first time. And in their scenario, they were going to use a third party. I think they're a third party processor. But what was going to happen is that the third party processor ran it all, including the connection to the Fed. And in the discussion with my colleague, we were talking about, the fact that they need to have all their due diligence really done well. I called her back this morning because I knew we were going to do this episode. And I said, you know what? If they really need to set their exposure limits, transfer them to the third party so they know their maximum exposure every day. Thoughts?
Yeah, no, I think anytime you're allowing what that would be considered a direct access type arrangement, I would absolutely look at the Fed controls, because you can set at the operator level by originator ID. You can make sure to either monitor by exposure date or by process date. I would highly, anybody that does not control the file, right? Because you're not touching the file. It's going from customer to third party to the operator. Even with online banking, you're not touching the file, right? It goes online banking, the core comes in and pulls it. The bank's actually no longer touching the file. That's why this is also important to think about those limits. Again, in the 80s, 70s, you were uploading a file or a disk. You had control of the entries, right? So you could get away with being lazy on limits and I think there's so many different types of arrangements. The only way to protect yourself is through proper establishing of the limits and proper monitoring of those limits, right? Don't forget, that's the second part of the rule, is establish the limit, then monitor it, enforce it, and then periodically review it. So those are the 4 steps. And I think when you're in those relationships, you have to look at the operator tools, because they've become really good, number one. And it's just, all your concentration risk would be at the third party if they're also managing your limits for you, right? So they're doing everything now. That's a lot of risk there, right? Think about, having no control of something, right? Yep. So
I thought I had you with that one. Let's see if I can have you. This is my last question. So we've never talked about this, I don't think. In a scenario where, say an originator starts out 10 years ago and they have 100 customers and they gave them all $1 million. And say they continue to add originators and they continue to up exposure limits. Can this exposure limit, I want to say cause a problem, but limit their scalability as far as adding new originators?
Well, so it depends, right? So if you look at some of the financial institutions, they'll tell you that when they get reviewed by their regulators, that some of them are looking at a percentage of capital, right? Like the OCC board reporting says you have to present what is your percentage of capital exposed via ACH origination. And some regulators get comfortable after certain percentages, right? We used to have in Connecticut, it doesn't exist anymore, it used to be 25%. It was a state thing. But you would, if you were over that, if you were exposed in your capital more than 25% ACH, so that's where you could run into a problem, is with a regulator. So if you have limits that are so high and they're not needed to be that high, it could ultimately show on a report that, yeah, the bank is technically exposed to $600 million, even though in theory it's $100 million. For regulators, that's too much of your capital exposed. then you got to go back and relook at the limits anyway. So, again, it's not just a check the box item, put $1 million for everybody, and I've done it. We have to break that mindset. And NEFI is still doing that. Reach out. We can help you with this. I mean, we can walk you through different ways of doing it. There are tools you can use. Rewriting your policy is not a hard thing to do, right? Coming up with, and it's not like you have to do this the same again for everybody. So let's say you had 100 customers, Joe, and 5 of them processed like $10,000 files and under. Forget those people, right? Their limit's $10,000. We're not going to spend any time. We're going to spend 90% of our time on the people with actual volume, and that's how the policy is going to be structured. So if you're looking for a limit over 50,000, here are the 5 things you need to have. If you go 50 to 100, here are the 6 things. 100 and above, here are the 7 things. People get so panicked because a lot of their customers are so small. You still establish a limit because the rule requires it, but that doesn't mean you have to review that limit every year. It's a periodic review. You could set that to be reviewed every 2 years, and then your higher risk ones every 8 months, whatever, whenever cycle you want to get put on. So don't let the existence of the overabundance of small originators make you go, oh, this is too hard to redo, because it's really not. It's an easy process, and at the end it becomes more efficient. We were talking with a bank about 2 months ago. They were spending 380 some odd hours doing reviews. And it's like, well, we could cut that in half by just looking at your customer list and extending some of those reviews to every 2 years, because they don't have lots of returns. They're great customers, right? Like this idea that they all have to be done at the same time and your policy can't be different. I don't know where that comes from. That is not written anywhere, either in the OCC, the retail handbook of the FFIC, or the NEACH rules. That's just become like this mythical thing, like, oh, we have to do it every year. And at the same time, it's like, no, you don't. And in fact, that's a waste of energy, effort, and it's really inefficient.
Excellent. Any parting words?
No, I just think everybody should take a peek at this article. It's really well done. And also just read the first couple of pages of Article 2 in the rules. You know me, I've been pushing NEACH to make Article 2 the first 3 pages and eliminate everything else, because I think it really gets at what you should be doing as an ODFI, those first couple of pages. Prerequisite to origination, read it, love it, read this article, and you're on your way.
All right, that's the instruction. Read those pages and love it. All right, thanks for joining me. Thanks, Sean. You're always great. Appreciate it.
On behalf of NEACH, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of NEACH.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.